We will have an interesting trio of individuals to start with us this morning, with three wise men on the market environment. Our three wise men are Dick Forsberg, who's head of strategy at Avalon, Shane Matthews, head of strategic and market analysis at SMBC Aviation Capital, and Peter Negline is head of strategy and market research at BOC Aviation Limited. Please join me in welcoming Dick, Shane, and Peter to the stage. Thank you. Thank you. As always.
Well, good morning, ladies and gentlemen, and welcome to sunny Orlando. And coming from Europe, it's particularly nice to be here at this time of year. I can see through the lights that the room is nice and full. So thank you all for coming out to listen to wise comments from three strategians, I suppose, for a better word of describing us. We all have the word strategy, or connotations of that in our titles. How strategic we are, you'll be able to judge over the next 45 minutes or so. The format is that each of us is going to lead on a topic, and we will then discuss where we agree and disagree with each of those topics. That will take us through about 30 minutes, and we want to dedicate at least 15 minutes at the end to your questions from the floor. So you have the app, you will be able to ask questions, and I am in control of which ones get asked. So they'll all appear here on the tablet, and we'll get through as many as we can. So in terms of introductions, I think most of you will know everybody. On my right is Peter, on my left is Shane, and for any confusion, I'm Dick. So I think we'll move straight on and get started, and Peter's going to lead us off with the first topic.
Yes, good morning, welcome. I'm going to be speaking to you today primarily around the macro environment that's in the world that we live in. BOC Aviation, we're reporting our results on Wednesday, so there's legal restrictions about what I can say, both about the company performance and short-term industry outlook, so hence my focus on the macro environment. And some of the questions, obviously, I'll have to leave to my fellow panelists to deal with, depending on what conflicts arise there. Now, when we think about the macro, and certainly if you read more of the popular press, what you're seeing a lot of is references around the word recession. And the thing that I want to focus you on is what's giving rise to a lot of that discussion. And in particular, it's best to focus on market data, because there's a lot of information we can ascertain from market pricing activity. And what you see in this chart on the left-hand side here is the yield spreads between the 10 and the 2-year US Treasuries. And this is a constant maturity data that's supplied by the Federal Reserve. It's a monthly data going back to the early 80s. And what's important here is the fact that this spread does go negative at different points in time, and each time that it has gone negative, it has predicted the last 4 recessions. And that timing difference between when the data goes negative and when the recession is officially deemed as starting is somewhere in the sort of 12 to 18 month period. And as you can see, we've seen a very sharp decline in that spread over the last few years, and of course that's stimulating this debate about recession. And it's not that I want to dwell on that, but let's start from that position where the media is focusing everybody at the moment. But let's take a moment to look at the two different parts of that left-hand chart. So we have on the top part there on the right, the US Treasury, 2-year Treasury yield. And I've drawn on that a long-term downtrend. Technical elements are some parts that I find quite interesting as they occur in charts. To be honest with you, we could have taken this back to the Volcker era in the early 80s. That downtrend would have carried on for a much longer period, but the chart gets too small. So you'll see here that sort of through last year, we saw a very powerful upward move above that downtrend, driven to some extent by the sense that this animal spirits that came alive in the US, also the impression that inflation and wages and so forth were all going to start to rise as the labour market tightened up. You'll see that's reversed a little bit in the last few weeks, but nevertheless it's staying above the longer term trend. What's interesting is on the bottom right-hand chart, where people ask, 10-year Treasury should really to some extent be a reflection of the cost of money for longer term investment, with some element of inflationary expectations built into that. but it's not holding above that long-term downtrend. It did pierce through that a few months ago, but it's fallen back below the long-term downtrend. And we'll come back to this issue around inflation and inflationary expectations, but clearly they're not as high as people think in the short end of the curve. There's also concerns about US deficits and so forth that are being reflected in the 10-year yield. So you've got very different dynamics here. And I think this is important issues to set the scene for the notion of the recessionary discussion that we need to have as we go along. Now, when we think about interest rates, the cost of money and so forth, we also can't ignore the dollar, important within the aviation industry. In my opinion, a weaker dollar is generally a better outcome than a stronger dollar. And we saw that in some airlines, certainly here in the US, where they're selling tickets abroad. If the dollar's too strong, it ends up hurting their unit revenues and so forth. What's interesting on this chart, which is an index of broad money index that the Federal Reserve publish on an inflation-adjusted basis, the dollar is kind of interestingly still at levels where it was back in the early 70s. But what I want to focus you on actually is this little part on the right-hand side, and it's kind of really, that's the Trump era, in particular the V reversal that we've seen there. Now, the US being the reserve currency for the world, the US in itself can't necessarily influence heavily the value of the dollar. That's being done, for example, by investors that buying and selling the yen along with the Bank of Japan will set the value of the yen, and it'll be similar circumstances, be it China and the euro and so forth. So the US can't entirely influence the value of the dollar, except in two extreme circumstances. And one of those would be a currency, a debt default, which in US political environment would be entirely unacceptable, or you have a political crisis. And there are some pundits out there that sort of say, well, is Trump the political crisis? I'm not American, and I'm sure you'll have your own views on all of that, but Trump to some extent did want to talk the dollar down, and that was certainly visible in this downward part of the V that you can see on the right-hand side. If he really wants to boost the trade environment for the US, a weak dollar is a good starting point for him. But you'll see the reversal on the upside of the V. He couldn't control the dollar on the downside simply because the US was raising rates when everybody else was either cutting or holding rates. And equally, there was also political crises in many different parts of the emerging world. You think of Turkey and Argentina and Brazil, Russia and so forth, India and even. Many different countries have seen their currencies weaken, and that's domestic circumstances that again created a slightly stronger dollar that was something that the US couldn't control. So for the moment, as far as we're concerned, airlines really need to be positioning for dollar volatility simply because domestic issues versus all the broader geopolitical issues that we see in the world are driving quite a lot of volatility. And that volatility last year had significant impact in the emerging markets, and those countries involved don't want to go down that road again in the short term. Now, when we think about jet fuel prices, because it's a significant part of costs for our airline customers, what I show you here is a Singapore jet fuel price. It's on a monthly average price because our airlines pay monthly average prices, so we want to look at it from their perspective. I very cheekily put in there a 10-year moving average, which is the blue dotted line. Why did I put that in? Well, because it kind of seems to pick up some interesting levels. I can't tell you exactly why, but do we need to understand it? If it's simple and it kind of works, we're going to run with it. And in the bottom of the chart there, you'll see the grey shaded area, which is the crack spread, which is the difference between the Singapore jet fuel price and the Brent price. And what's interesting is just in times of volatility, I know that an appraiser group last week put out a note that's sort of reiterating themes that have been there for some years around the issue of dollar volatility, and in particular fuel price volatility is what creates the risk of rising airline bankruptcies. And you look at the volatility in 2008, both in the jet fuel price, sharp moves up and down, as well as the spike in the crack spread there, going up to about the crack spread's red off the right-hand axis, I should say. So that, getting up over $30 a barrel was really something that whipsawed the airlines, and no surprise, 2008, a large number of bankruptcies. And what have we seen in particular on this right-hand side in the crack spread in 2008, 2009, similar sort of spiking in values. Again, no surprise that we've seen some increase in bankruptcies of airlines over the last year or so. But I just want to point out the banner across the bottom for those of you not familiar. You should be tracking developments in the shipping industry because the IMO, the International Maritime Organization, has deemed that from the end of this year, all major commercial shipping has to move to low sulfur diesel. That low sulfur product comes out of the same part of the barrel that jet fuel does. So there's really a lot of conjecture in the market at the moment as how much of this incremental demand for low sulfur fuels is actually going to hurt the pricing of jet fuel. And there is some expectation in the market that maybe there's going to be a $6 to $8 premium in that crack spread added through next year in particular and beyond, depending on how the refiners move their production around. And there's a lot of uncertainty as to exactly how the refiners are going to help or hinder the supply of jet fuel. So there may be, hopefully not much of a step up, but something that's definitely worth the industry's attention to watch over the next 1 to 2 years. Now, you're all familiar with the US, we've discussed that momentarily, but let me talk a bit about China. You're all aware that China has had internally a problem with debt defaults, in particular their domestic bond market. And that is the government decided correctly that they needed to prick that bubble to ensure that it didn't get any worse. So they are trying to deleverage the economy with the excess debt that can exist there. And they that did start the slowdown that we saw sort of through last year. Now, there's certain things that the government are trying to juggle at the moment. There's 3 initiatives that I want to highlight to you. The first of those is that they really need to keep support for the dollar through a $3 trillion minimum balance for their foreign reserves. They want to keep 6% growth for domestic stability, and they don't want the currency to weaken beyond 7. Okay, if you think about the economic dimensions of all of this, it's actually pretty difficult for them to juggle, but that's the challenge that they face right at the moment. Now, you're all familiar with the trade dispute, and that's hopefully going to be resolved sooner rather than later. It's impacting GDP in numerous different places. I just want to highlight to you that the complexity of this, and I'm not a trade lawyer, but in a China context, you've got to think about this in a slightly broader sense. Now, there are short-term issues around intellectual property and other issues to do with buying more agricultural products and so forth out of the US. To some extent, they can be resolved at a fairly simple, straightforward level through negotiation. But one thing that I find interesting to highlight is the longer-term issues. Now, I was at a conference in Asia last year, and the chairman of a European bank that I shouldn't name mentioned that the foreign banks only have 1.5% market share of the retail market in China. And his comment was, we should have at least 40% market share. So there is a lot of corporates out there wanting to build their presence within the China domestic market. But then when I talk to China economists, and they're saying, well, that means we've got to open our capital account. And if we open our capital account, then we have to float the currency, we have to open our bond market, and we have to consolidate the A, B, and H share market. So there's a lot of significant structural economic issues that China's got to deal with. Now, I'm not saying what China will set its own timetable. We have to understand that. And there are complexities in all of this in the background, but from a China point of view, some of the long-term asks are perhaps they can accept it. I can't speak for China, but they are complexities involved with actually achieving what some foreign governments will want within those negotiations. We've also seen in this effort for the Chinese government to try and hold the economy that they are providing stimulus in a number of different areas, and they are prepared to do more in that area. But please keep in mind that even though, as I mentioned earlier, there is a lot of debt within the corporate world, within China, there's a lot of debt within the municipal and provincial governments, the central government balance sheet is enormous and it's incredibly strong. And they can recapitalise the banking system if they want to, and they can deal with a lot of problems on the central government bank balance sheet that is not stretched overall. So I would just highlight that, let's not get too concerned too early. But can I just highlight one other thing for you? And that is that, in my opinion, over the lifetime of most of us in the room, China's really had 2 major economic problems. One was in 1999, and the other was actually in 1989 and 1994. In both instances, those events were preceded by food price inflation of over 40% per annum. 1988 and 1993 were those years of 40% food price inflation. You want political instability, that's the first thing to really, really trigger it. And we've got the risks around this African swine flu, that China is particularly affected by that. I'm not a specialist in the area, but it's just something we should keep an eye on, because If food price and pork price inflation in China really starts to take off, then that's something that would create an exogenous shock and could be very destabilising. Keep in mind also the key anniversaries, 1949, 1989, and there's others that also come up this year. And can I also highlight to you, the 1st of July 2021 is when the Chinese Communist Party celebrate their 100th anniversary of their formation. So Xi Jinping actually has quite a few reasons why he'd rather have political stability and growth ahead of anything else. We have here so we've talked a little bit about the sort of more the theoretical world. Let's look at the real US economy here, and it's a boom-bust index, which is the black line through that chart. The black line is calculated by looking at the green line, which is an index of commodities, excluding oil and timber, so it's real commodities like concrete and steel bars and things like that. And the blue index, which is the US initial jobless claims. And you know that's quite a volatile index because you get a lot of contractors that move in and out of work depending on the hurricane season. You've had the US government shutdown that created problems. So if you look at that black line, yes, there has been a correction on the very right-hand side of that index. It's this little bit of the last volatility in the very far right was due to the US government shutdown. So I don't think the index has stabilised at its sort of proper level once we get the data flowing on a more normalised basis. So there has been a correction. We are off our peak. But you go back to the 2008-2009 period when that index goes vertical on the downside, we're not seeing such a dramatic decline. So when I look at the real economy, I don't see the stresses that fit with what the media are telling us is we haven't had a recession for 10 years, there's got to be one coming. What's the real world telling us? They're kind of getting on with business. Now, I was at a conference last week, Doug Parker sort of said, we're not seeing anything in the data. His actual words were, we're not seeing anything in the data that suggests a recession is imminent. We're not seeing it in this industrial world, the real economy in the US. So my suggestion is let's be a little bit wary about calling a recession in the short term. Certainly, so we start with the definition, okay, two negative quarters of negative growth. But let's not also forget, we've seen quite a few mini recessions over the last few years, and tell me if any of these have really disrupted your business. So we saw the oil sector in a recession from 2015 to 17. We saw the retail, Amazon is ripping it to shreds, the whole retail market, right? A lot of retailers, as you know, you don't need me to tell you how stressed that is here in the US. You've seen the commodities really stressed in so many different areas. And you've seen emerging market recessions. And I should have added to this list Russia as well as you can see there, Latin America and different parts of Africa. So we've had all these different mini recessions. So I propose to you the suggestion of, do we have to have a global recession, or can we actually continue to muddle along with all sorts of stresses in particular pockets of the global economy without actually bringing the whole house down? And that's where I'm coming from. And the technology is just so phenomenal. The more conferences you get to where you can hear about the efficiencies, the cost savings, absolutely phenomenal. A fund manager came out last week and said that their estimate is that the technology advances and the capabilities and efficiencies we pick up through all the app technology that we've got is reducing US inflation by at least 50 basis points a year. Right? So you think structurally could we be in a longer term, lower interest rate environment? The technology to some extent is going to keep us there. Remember also, US inflation, actually I should have said earlier, in two parts. You have US services inflation, education and healthcare, which is running at very high levels. But then you have the merchandise part of it, which is driven by Amazon, which is seeing a deflation. So that's why the whole inflation debate, to be honest, is a little bit more complicated than just the raw data says. This app and technology world means so many things. How much of your productivity is just not captured in GDP anymore? If you're sitting on a plane working, doing emails and all sorts of other stuff, you're working for your companies, it's not recorded as GDP. And the other thing is, because we're now living in a much more globalised world, I found it fascinating to learn that you go back 25 years, for every major patent that was registered, there was about 20 to 30 patents that followed on from that. Today, because of the more globalised world, every major patent that's issued, there's 400 being issued on the back of that. So efficiencies across the world are just phenomenal. It's deflationary. It creates a longer-term low-interest environment. I think it pushes way out the risk of recession. Now I shouldn't be so bold as to say, yes, we can get exogenous shocks. We have the risk of the swine flu in China. There are other risks, the war in the Middle East, something other dramatic like that could be quite problematic. And finally, I just want to leave you with some thoughts on the demographic side, which I think has a huge implications for the global economy. Let's start at the bottom of the chart with the black line. So this is the percentage of the global economy that has a GDP per capita above $6,000 per annum. Why do I focus on $6,000? Well, actually, if I was Procter & Gamble, or they'd be sort of saying, well, I can sell my product at $3,000, I get a broad-based acceptance of my product. Air travel has a higher income threshold that's typically identified at around $6,000. So that step up in 2012 was when China crossed the $6,000 limit. You'll see then on the dotted line is the number of countries that are in that threshold, and then the grey line. So most of the GDP, that's read off the left-hand side. So we've got most of the global economy, 95% live on $6,000 or more per annum. But think about this, 50% of the world hasn't crossed that threshold. India's GDP per capita, $2,000 per annum. Places like Indonesia at $4,000, Pakistan, $1,500. So many countries that actually have many, many years before they're going to be getting into a level where they can actually be really active travellers. And the thing that final thought that I just want to leave you with, think about this. In 1989, South Korea and Taiwan opened up their market for outbound travel. It was restricted, illegal for their nationals to travel outbound prior to 1989. So in 30 years, you've seen the explosion of growth and how you all know in the aviation world how important South Korea and Taiwan is to aviation. Well, think about where China's going, where India won't be there for another 12 years or so. So the demographic side is so powerful, and all of these people having been restricted and sort of limited in their travel, of course they want to go see the Champs-Élysées in summer, and they do want to go stand at the top of the Empire State. It's a very, very long-term, impressive story, and that's why we all invest in aircraft on a 25-year basis. Thank you.
Thank you, Peter. And I think you've touched on a number of key issues there, both in terms of the macroeconomic elements that keep particularly airline CEOs awake at night, but also some of the regional issues that we need to focus on. And China, because of its scale and the increasing dependence of a lot of us in this room to grow our business there, we're very focused on that. But China's not the be-all and end-all. There's an awful lot of Asia, let alone the rest of the aviation, will be on China. So we're right to think about it, but I think we shouldn't be letting it drive all of our activities. But I think some of the elements there in terms of fuel price and in terms of the exchange rate, the strength or otherwise of the dollar, really do have very immediate effect across the whole of the business. And it's pretty clear that if you think about exchange rate exposure, most airlines around the world in emerging markets that face those exposures aren't doing very much to mitigate that. There are cases where you see hedging policies in place, but most of the time you don't. So do you think there's more that airlines could and should be doing to protect them from the downside of a strong dollar, particularly where they're predominantly domestic revenue generators?
Probably yes, but it depends on the cost of the hedging that they have in their local market. I mean, that's the problem why many of them actually finance aircraft in dollars, because they can't get the depth of the market in the local currency that they need in this volume that they need. So it really depends on the cost of it all.
Yeah. And I mean, we are stubbornly and determinedly a dollar-denominated industry. And I mean, we've been talking about, well, maybe we could start trading airplanes in euros. We've been talking about that for a decade. It's not come any nearer, and I suspect it won't. Chinese airlines are managing to finance a few of their deliveries in renminbi, but only with domestic banks. And that, in my view, is not going to become global. So I think we're stuck with dollars for the foreseeable, and we have to live with, whatever US policy throws at us. That would be my view.
Fair enough.
So we should move on because the clock is ticking down. And I'm going to pick up the second segment, and I want to talk about the market dynamics in terms of supply and demand, and where we are in terms of a balanced market, and why perhaps we should be concerned. So we've come out of a long period of growing strength in the market, 9 years of industry-wide profitability, double-digit growth in a lot of passenger markets above average RPK growth for the last number of years. So some of the historical trends and patterns, appear to have been diverted. Perhaps, old trends are no longer new trends. I do believe that there are factors, particularly in the way that markets are shifting from mature Western zones to emerging markets, not only in Asia but also in Latin America and Africa, that I do think that that 5% per annum forever paradigm has changed, and for all sorts of mainly demographic and personal economic reasons, and probably going to be on the higher side of historical trend lines. But supply and demand, we've seen again for the last 7, 8, 9 years, RPK growth running ahead of ASK growth. Yet at the same time, we've seen an increasing amount of capacity being delivered into the market. Across the board, manufacturers have increased production rates and delivery rates, and airlines have been very keen to soak up the capacity that is being offered to them. So whether it's direct sales from the OEMs or whether it's through the leasing channel, there seems to be no end to the appetite of airlines around the world to take on new generation, efficient, and in many cases very aggressively priced capacity. And that has been pushed down into the market through very significant growths in ASKs, 5, 6, 6.5%, 7% over the last 10 years, and in all except I think 2 years, still ahead of traffic growth. So airlines have figured out how to fill airplanes, and they have been very happy to succumb to the beguilement of the OEMs saying, we'll do you a great deal on these fuel-efficient airplanes. You don't want to be caught with old generation airplanes when fuel hits $200 a barrel. Think of the emissions charges, think of the noise charges, particularly in mature markets in Europe. And that has created a massive surge of new technology aircraft, not only in service today, but also the backlog. So the OEMs are sold out for 5, 6, 7, 8, 10 years. And are having discussions where they're quite reasonably saying, well, we've got no product to sell. We are having to disappoint potential customers. We have nothing to supply. And we are also slightly embarrassed because we've deliberately oversold our short and medium term capacity to build airplanes. So we should build more airplanes. We need to increase production rates, both single aisle and twin aisle airplanes. We need to ramp up. The demand is there. Clearly it is there. Airlines are making more money than ever. They're filling airplanes to greater load factors than ever. RPK growth, as I say, is in excess of seat growth. Everything is groovy, as a good friend of mine would say. But is it? Airline profitability is not universal. It's not uniform. Almost 50% of the overall industry profitability is being generated in North America, where airlines learned a stark lesson. Under a protected environment, were able to restructure their businesses and have, since the early 2000s, kept capacity growth on lockdown. They get it. They understand how they can drive profitability. Other airlines around the world haven't all subscribed to that, and there is this heady aroma of kerosene and new aircraft and new deliveries and battling for market share. So an 85% industry average load factor sounds wonderful. But if at an 85% load factor, airlines in certain parts of the world are not consistently making money, that tells you that there are issues. Now, some of those issues might be the exchange rate has moved against them and their local revenue earnings are now being overwhelmed by the exchange rate because all their costs are in dollars. Oh, and by the way, fuel price has gone up to a point where between the crack spread on the refineries and the local taxes, fuel is now 40+% of their operating costs in some cases. So there are macroeconomic reasons why airlines might be under profit pressure. But underlying all of that, there is in my view, the very real concern that airlines, kind of like OEMs, are focused on market share and focused upon filling the capacity they are committed to in order to achieve improved market share positions. And that means giving up one thing, and that one thing is yield. So to paraphrase some comments I was making earlier in the year, one of the issues with the industry today is that there are too many cheap seats being sold in the market and not enough expensive seats. and that airline discipline is not universal. And where airlines on a sort of sporadic and regional basis are getting into difficulties because of a combination of macroeconomic factors and also their competitive and, I would argue, overcapacity situations, that would cause me, if I were sitting around an OEM boardroom, to be saying, hang on, is this the right time? And is this the right environment to be increasing production rates? And I would conclude that no, it is not. And whether we still have a long runway of strong economic environment on a regional and global basis ahead of us, or whether the best is behind us and we are now looking at some point of cyclical inversion at some point in the future, and I've long since given up trying to predict when that might be. But if there is uncertainty in the market, and clearly there is uncertainty in the market, and that level of uncertainty is increasing, this is not the right time to be ramping up production. Because if production continues to increase, and airlines are the foie gras geese of the industry, and they're being force-fed this rich diet of shiny new airplane capacity, then at some point they are going to come to the conclusion that other capacity has to be given up, and that other capacity will be midlife airplanes. And as many of you will know, I'm a strong proponent of a long-term 25-year economic life for metal in this industry, and there is still no evidence that consistently there is downward pressure on that. However, I think continued upward pressure on production rates will at some point, and it'll probably be sooner rather than later, start to accelerate retirements of older generation airplanes. That will have a knock-on effect through economic life into depreciation rates, and for every year you take off a depreciation assumption, the unit cost of financing that airplane increases for the remaining years. So as depreciation reduces the cost of financing them, whether you're financing through a lessor or whether you're financing through the debt market, the cost of ownership is going to go up. So that will hit the airlines because their operating costs from the fixed cost perspective will increase inevitably, except if the airlines are in a strong negotiating position and say to manufacturers, but more importantly from where we're all sitting, to leasing companies to say, no, I'm not paying that premium. You live with the issue of a shorter economic life. Now, if that happens, the lessor's business model will start to distort, and that over time will cause some investors to say, no, I'm not comfortable with where this is going. And if liquidity starts to slow up, and I'm painting a bleaker picture than is likely to emerge, but over time, if the business model starts to look less attractive, and Shane's going to be talking about the hows and the whys of the lessor business model and the investor model, if the investment prospects don't look shiny anymore, then liquidity will start to leave the market and invest elsewhere, and that is going to hit the OEMs exactly where it hurts. So there is a cycle in this, there is a circular process in this whereby unintended consequences might come back to bite us all if we keep on being too enthusiastic about capacity growth. So that is my point of view, and I know my colleagues have slightly different views on some of that. So we've got a few minutes to chat about that if you want to chip in before Shane gets on with his segment.
No, I think Dick is making a very valid point about kind of the availability of cheap seats, because it kind of is very much a driver of kind of industry profitability in recent years. And it probably does hide the idea that the business is still cyclical. I think the business is cyclical in parts. The reality is business traffic is a function of GDP growth. People travel on business because of the economic cycle. And if that cycle steps back, then you will see some squeeze on the profitability there. The huge amount of cheap seats that we've seen come in on the back of the growth of the low-cost market, particularly in Asia, which has taken on the baton, but even here in the US, we have the ultra-low-cost carriers like Allegiant, are effectively disguising what I still believe is the cyclicality that exists within the industry. And I absolutely agree that the manufacturers have found themselves in a very interesting position. They've oversold, but because, and I'm going to touch on this a little bit more detail, because they've oversold into a market that has excess liquidity. they did not expect all of these planes to be financed and delivered if they put their hand on their heart. But they now find themselves in a position where the cost of not delivering those airplanes is probably quite expensive to them, both on a reputational and on a financial basis, and accordingly they've looked to increase production. And let's be frank, none of their salespeople particularly like the idea of going out there and saying, the first plane I can give you is in 2023, 2024. It's a very hard way to make a living if you're commission-based, that you're promising planes that far out. So, to be fair, Dick, I agree with a lot of what you say. I find it very hard to fault it.
So, given where the clock is going, we probably do need to move along. Okay. And I mean, it's a nice segue, I think, into what you were wanting to talk about, Shane. And maybe you could try and be succinct so that we do give the audience some time to...
no pressure then.
No pressure.
No pressure. Okay, well, look, what I do think is quite interesting is that the Three Wise Men have all come from Eastern-owned organizations. And maybe it was just a reflection of they were the three that were quickest to stand up. But you have seen a change in the move towards ownership within the leasing industry. When we started to put this together, there was three wise men should bring three gifts. And we thought about this carefully. And so we've decided to go with gold, common sense instead of incense, and mirth. I'm here to provide the mirth, perhaps. Can't guarantee it. But what I did want to talk about is, and I do feel like, look, I'm talking to an audience of people who are expert and in many cases, many, many more years experience than me. This is the cycle that we talk about, why people are attracted into aircraft leasing. There is a low barrier to entry. You have stable lending-like margins, so not surprisingly, you get a lot of financial institutions, and in fact, two of us here are owned by financial institutions. You can get money deployed very, very quickly in this industry, so you can build scale quickly. You take a lot of containers to get to the level of some of the businesses that exist, even the smaller businesses within this industry. There is a low credit default, and I'm saying low. It's not the word no, and I'm going to touch on that later. It is a core asset for many of the people within this industry. So not surprisingly, no matter where they find themselves in the cycle, they will try to hold on to the aircraft. Stable asset returns coupled with low asset volatility, and I'm going to touch on this a little bit more. It has to be the right asset. And I think the relative US dollar strength is important. I know Peter touched on the idea that a weak dollar is very good. It's very good for the airlines. It's not always good for the investor. But we started to take a little bit more look at who's come into the industry in recent years. And what we found was that, I'm going to click through these a little bit quicker than talk through each of them. We saw many Asian investors enter this industry. In some cases, they were coming because of government policy. In some cases, there was a real currency arbitrage there. They operate within the fastest growing region in the world, so not surprisingly, they're in touch with this, and they've decided this is an industry they'd like to tap. There's a lot of excess domestic liquidity within Asia, and not surprisingly, people want to put it to work, and this is an industry that potentially does that for them. And then there's a tax planning aspect, and I want to talk a little bit more about that later. What we're actually seeing is headline lease rate factors that are very much driven by tax situations. Now, I talked about the low barrier to entry. And we're just going to take you through a typical life cycle of a leasing company. I'm not necessarily going to attach any names. Each of you will know somebody who fits in. So, in the startup area, you build up your fleet over time, obviously, as you would expect. Most people have started in this industry through a portfolio purchase. The barrier is really only capital at this point. There are plenty of people whose business model requires them to sell aircraft. Third-party investors can come into this relatively quickly. They buy an existing contract, an existing cash flow. Many of the appraisers in this room will help them value it, even if they don't know a lot about what they're buying. However, as they move on, they start to look at sale and leaseback. This is now a point where you can actually have much greater choice in who you're doing business with. But again, you don't have to find the airline. The airline will find you in many cases through an RFP. We're talking about a business which now has 30 or 40 people chasing each and every sale and leaseback. Highly, highly competitive. Now, when you get more comfortable, you start to look at direct orders. Now, this one requires a lot of technical knowledge and client reach. You have to be comfortable that you can place these aircraft. You have to know exactly what you're buying, and you have to know how to price it. So, as I would say, it's becoming increasingly complex as we move up this fleet size. And then ultimately, you become a real leasing company. You manage the lease expiries. You move aircraft from one operator to the next. You're no longer just a financial institution who's using its kind of cheap capital to kind of drive better returns for its overall book. And at some point, and this I think is very important, you have to start trading. Many, many people don't get this. Plenty of people try to hold on to the aircraft for the full 25 years that Dick mentioned. But trading has a lot of uses. It gives you a reality check every now and again. However, if you've made mistakes along the way, that reality check will turn into $1 plus and minus. Now, here's a little bit of advertising for one of the members. IBA recently did a piece of work, and they were just highlighting what was happening in the leasing market. So what we've seen here is that many lessors have stepped away from the sale and leaseback market, the more established players. They've decided that they're going to focus in on direct orders. What is very interesting is some of the guys who said that they were only going to do sale and leaseback have actually now gone in for a direct order. The next chart just shows there's a disconnect between lease rates and interest rates. Peter talked about the interest rate environment. What's happening in the lease rate market is kind of less clear. There seems to be a disconnect. Again, I'm going to move through this reasonably quickly because I'm conscious of time. But your lease rate is not just a function of interest rates. There's a lot of other factors out there at the moment. They range from diversity of financing, aggressive lessor business plans. There are more aircraft sitting with lessors at this point than there has ever been before in absolute numbers. The increased level of production has resulted in more lessors being out there, and they're chasing the market aggressively. The production rates have also had an impact on lease rates. The airline profitability is still quite good, and demand is still out there. So broadly, there is demand for the aircraft at this point in time. This one just highlights the fact that lessors are incentivized to reinvest their cash. They have no choice but to, because ultimately their measures, we do not get any benefit from keeping cash on hand. So much as many lessors will take the view that parts of the market are overpriced, they will effectively still look to participate in that market. If, however, you've got the broad mix, you can choose where you pick your fights. But if you're a small startup who's effectively looking for scale, you're going to chase every deal. And you're going to chase where we see the most competitive end of the market, which ultimately is the sale and leaseback market at this point. Now, I do feel the market is priced for perfection at this point. The assumptions out there is that we haven't overpaid for assets. You have the right security package in place. You've correctly quantified the maintenance risk and costs. You're confident in the residual value, and you've matched your duration. To be fair, I don't think that's ultimately the question, because many people have actually just jumped in there blind. As I mentioned earlier, with tax planning, there are talk of lease rate factors as low as 0.5. You annualize that, that's 6%, okay? Your depreciation should be running at about 3 to 4%. Your overhead should be running at about 1%. That doesn't leave a lot of money there on the table to cover your interest costs. Now, I would highlight that tax products are finance leases for the most part. So we shouldn't extrapolate these low numbers we hear. But those low numbers set a base for other products in the marketplace. So for the most part, I think people are out there. They have mismatches in place, and they don't necessarily have a full understanding of some of the risks they're carrying. But it won't be an issue until the aircraft is returned or there is a default. And in some cases, they're going to happen quicker than people think. Now, the final point I just wanted to make, and again, we're pretty stuck for time, so apologies, is that not all aircraft are the same. Like at the end of the day, lessors have been taking a huge market position in the narrow body space. They've been reasonably aggressive in some of the wide bodies. But there are people out there holding aircraft where effectively the volatility and risk that they're carrying is well ahead of anything that they've assumed. So with that in mind, I'm just going to wrap up quickly. We've kind of slightly running up against time. So I'll hand over to Dick if there's any questions.
So thank you, Shane. I mean, I think you've summed up neatly what the investment thesis is and why it is under some pressure. And I think it will be some turbulence as we move through the next phase of the cycle, and I think there will be some distress among what is a burgeoning lessor community. And we've gone, when I started in the leasing industry, there were probably 5 or 6 serious names in terms of contenders, maybe not as many as that. There's now 106 or 156 or 206. I don't know what the number is, but everybody and his dog seems to want to get in the industry, and they have different approaches to how they're going to do that based upon different levels of experience. So I'm slightly guilty because my 15 minutes of questions promised didn't materialize, but on the other hand, neither did the questions. So I'm taking it as a compliment to the panel here that the audience was so mesmerized by the conversation they couldn't get their thumbs active to get the questions coming in. So there's really, other than the most popular question is, do strategists know how to keep on time? And the answer to that is self-evident. There's one area which did draw a number of questions, which we will briefly deal with and go slightly over limit, which is about the max placements being a little harder than many thought they'd be. How are the lessors facing up to the challenges of placing aircraft? And I think it's broader than just MAX, because I think we would agree that MAX placements are quite challenging. NEOs haven't been super easy. So it is an issue of availability and timing, and my view is that the OEMs have been, cavalier is the wrong word, but they've been super enthusiastic about selling new generation airplanes to all comers in the lessor community, and that's created some challenges.
Yeah, look, I think probably if you look in detail, what seems to have happened is I think Boeing have perhaps been a little bit more aggressive at putting aircraft into the lessor channel. Airbus perhaps were a little bit more aggressive at putting aircraft into startups. Yep. And it's kind of resulted in a slightly different dynamic. I would agree that the MAX is underperforming relative to the NEO, but we're placing both of them and we're well placed out. But you have to look at giving your client not only a value proposition, but also help them and produce client solutions, move aircraft around, work with kind of the existing fleet, etc. So it's requiring the more established lessors to be inventive.
So I think with that, we're going to have to draw proceedings to a close. So I'm sorry if people tried to ask questions and they didn't get through. Please don't stop trying. Please remember the app is there. Use it through the subsequent sessions over the next 2 days. We need questions to stop us all from talking too much. Thank you very much for your attention. Thank you, Peter. Thank you, Shane.
Thank you.
Thank you, Dave.